Our next guest's stock-picking prowess has earned him the nickname the Oracle of Tampa. Jay Bowen manages the nearly $3 billion Tampa Police and Firefighters Pension Fund. He's live with us today in Atlanta. Jay, it's nice to see you again. Welcome back.
Thanks. Good to be here.
Yeah, so how does the Oracle of Tampa, as some have called you, view where we are in the stock market today?
As far as our market here in the U.S., I think we could very well be range-bound for a while. There are a lot of uncertainties swirling, continue to swirl, and until we get clarity on those issues, and I'm talking, just to give you a couple of examples, we do have decelerating, notwithstanding the jobs report this morning, we do have decelerating job growth and decelerating economic growth and decelerating earnings growth and decelerating business investment and decelerating Federal Reserve and commercial bank credit. So granted, a lot of that might be, you could say that the first quarter, and you've got some transitory issues in terms of the weather and oil, but I still think until we get some clarity on those issues, we could be range-bound. We think Europe...
It sounds like you think it's something more, that this winter freeze-up was due to more than just Mother Nature.
Well, as far as the market is concerned, I think there's we can do okay in here. I do think that the some of this deceleration is somewhat transitory, but from a relative standpoint, I think that Europe actually looks a little bit better to us in terms of investment opportunities.
Are you saying the valuations are more attractive there? Is that why you think Europe's turned the corner?
Well, I know this is not a new story. Obviously, they've had a strong start to the year. But if you look at the last 3 years on a cumulative basis, the U.S. is up over 80%, Japan's up over 100%, Europe's up 5%. Now, that alone is not a reason to buy Europe, but there are some economic and monetary reasons present that I think make it attractive. Number one, it is cheaper, yes, on a PE basis, and the dividend yield is more attractive. Number two, this 20% move down in the euro-dollar cross rate is giving these European multinationals a tremendous comparative advantage, and it's becoming embedded in their earnings reports. So from that standpoint, if you look at some of these high-quality multinationals, I think from a relative standpoint, the outperformance is there. Also, the fundamentals are improving there. If you look at they've just upgraded the growth forecast, the European Commission,
right.
Industrial production's doing better, exports are doing better. So I think, and then of course the 800-pound gorilla is the QE, where Draghi has pledged $60 billion a month, a minimum through September of 2016. So it's really open-ended. And as we know, if you ask, well, what has U.S. and Japan done over the last 3 years, and what has Europe not done, we know the answer is QE, so I think the liquidity situation is important.
All right, we're back at Post 9. Let's bring back in Jay Bowen. He manages the nearly $3 billion Tampa Police and Firefighters Pension Fund live in Atlanta today. Jay, I'd like to get one stock pick from you, and maybe it plays into your thesis. Unilever, tell us why you like that stock.
That would be a good example. That's basically the Procter & Gamble of Europe, and that would be a good example in terms of playing some of these themes we're looking at, particularly the euro-dollar cross rate. They're a large multinational, and interestingly, they're in over 200 countries. They've got over 400 brands, and we really like the fact that 60% of their revenues are coming from emerging markets. We're particularly interested in China. They're really making some inroads in China, and with this relative comparative advantage over the next 10 years, it's estimated that the Euro region's trade with China is going to increase 50%, so they're very well positioned in that respect. Also, they've got a strong history of making accretive acquisitions, particularly in the personal care area, so I think their organic growth is going to look good. If you look at their latest earnings report, you can glean from the CEO's comments that there are more tailwinds now than headwinds. And it also has an attractive dividend yield. It yields about 3.2%. And another trend I think we're going to see, particularly in Europe, is they're in this search for yield, for high-quality income-producing securities, where 70% of the yield curve is negative, for instance, in Germany. I think the high-quality common stocks make a lot of sense from an income standpoint also.